Earnings season is one of the most volatile and exciting periods in the stock market. Every quarter, publicly traded companies report their financial results, often leading to dramatic price swings. For options traders, this presents an opportunity, not just to speculate on price movements but to strategically exploit changes in implied volatility. One particularly effective strategy during earnings season is the double calendar spread. Unlike directional bets that rely on predicting whether a stock will surge or plummet post-earnings, this strategy takes advantage of the differing time decay and volatility of options expiring before and after earnings. Traders who master the double calendar approach can generate consistent profits without taking on excessive risk. The double calendar spread is a neutral strategy that allows traders to capitalize on pre- and post-earnings volatility shifts. The setup involves two key components: selling short-term options, calls and puts, that expire before the earnings report, buying longer-term options, calls and puts with the same strike price, but expiring after the earnings report. The reason this strategy works so well is due to implied volatility dynamics. Options expiring before earnings lose value rapidly due to time decay and the absence of earnings-driven uncertainty. Options expiring after earnings retain their premium longer, as traders anticipate a large post-earnings move. By selling near-term options and buying longer-term ones, traders create a structure where they profit from the gradual erosion of near-term options, while maintaining exposure to a potential volatility spike after earnings. Implied volatility, or IV, is one of the most crucial components of options pricing. It reflects the expected price fluctuations of a stock over a certain period. Earnings announcements almost always lead to a spike in implied volatility before the report, as traders anticipate potential surprises. However, after earnings, implied volatility generally contracts significantly. The double calendar strategy benefits from this predictable IV crush. Near-term options decay quickly and experience volatility contraction, allowing traders to profit from selling these options. Longer-term options remain inflated, keeping the trade profitable even after earnings. This predictable pattern makes the double calendar spread a high-probability trade during earnings season. To illustrate how this strategy works in practice, let's analyze a real-world setup using Tesla Inc. ahead of its quarterly earnings report. Step 1. Identifying key levels. Before setting up the trade, the trader analyzes TSLA's 6-month resistance and support levels, which will serve as the strike prices for the options. Resistance level, $270. Support level, $190. Step 2. Setting up the double calendar spread. With earnings expected in 2 weeks, the trader initiates the following trades. Sell TSLA calls at $270 expiring 2 days before earnings. Sell TSLA puts at $190 expiring 2 days before earnings. Buy TSLA calls at $270 expiring 2 days after earnings. Buy TSLA puts at $190 expiring 2 days after earnings. At the time of placing the trade, sold calls at $270 were priced at $5. Sold puts at $190 were priced at $4.20. Bought calls at $270 were priced at $9.50. Bought puts at $190 were priced at $8.80. Step 3. Understanding the profit mechanism. Since implied volatility increases as earnings approach, the longer-term options maintain their value, while the short-term options decline due to theta decay. As expiration nears for the sold contracts, their time premium erodes significantly, allowing the trader to buy them back for less than they were sold. Additionally, after earnings, if TSLA remains within the projected range of $190 to $270, the longer-term options retain much of their premium, while the short-term options expire worthless. This setup ensures a profit due to the difference in time decay and post-earnings volatility shifts. Instead of holding the double calendar spread until after earnings, some traders prefer to exit 2 days before earnings to capitalize on peak implied volatility. As earnings approach, implied volatility, or IV, spikes, causing longer-term options to rise in value. Meanwhile, short-term options decay rapidly, creating an ideal scenario for closing the trade before earnings. At 2 days before earnings, the option values have changed, Sold calls at $270 have dropped to 80 cents, and sold puts at $190 have dropped to 60 cents. Bought calls at $270 have risen to $10.20, and bought puts at $190 have risen to $9.80. So, closing the position and realizing profit 2 days before earnings, the trader buys back the sold short-term options and sells the longer-term options at their newly increased prices. Closing short positions, or buying back sold options, bought back calls at $270 for 80 cents, originally sold at $5, resulting in a profit of $4.20 per contract. Bought back puts at $190 for 60 cents, originally sold at $4.20, resulting in a profit of $3.60 per contract. Closing long positions, or selling bought options, sold calls at $270 for $10.20, originally bought at $9.50, resulting in a profit of 70 cents per contract. Sold puts at $190 for $9.80, originally bought at $8.80, resulting in a profit of $1 per contract. Net profit calculation. Total profit from short positions, $7.80 per contract. Total profit from long positions, $1.70 per contract. Net profit per contract, $9.50. Assuming 10 contracts, total profit $9,500. Percentage return approximately 39% in 2 weeks. Why exit before earnings? Closing the trade 2 days before earnings reduces uncertainty risk while maximizing profits due to the peak in implied volatility. Holding the trade through earnings carries the potential for unexpected post-earnings implied volatility crush. Sometimes implied volatility collapses more than expected, causing long-term options to lose value rapidly. Large price moves, a major stock move could disrupt the profitability of the calendar spread, leading to losses. By exiting before earnings, traders lock in strong returns, avoiding the unpredictability of the actual report, while still benefiting from earnings-related volatility. Risk management and considerations. While the double calendar spread is a relatively low-risk strategy, traders should be mindful of a few key factors. Strike price selection. Choosing the wrong strike prices could lead to undesirable exposure. A good practice is to select recent support or resistance levels to minimize directional risk. Early assignment risk. Since short options are sold in this strategy, there's a risk of early assignment, especially with dividend-paying stocks. Unexpected volatility drops. If post-earnings volatility contracts more than expected, the long-term options may lose more value than anticipated. Managing margin requirements. Since the trade involves both short and long options, ensure your account has sufficient margin to maintain the position. Key takeaway: why the strategy works. The double calendar spread thrives during earnings season because of the fundamental differences in how options are valued. Near-term options lose time value quickly. Longer-term options retain premium due to post-earnings uncertainty. Volatility contraction after earnings allows profitable closing of the trade. This strategy provides traders a structured way to profit from earnings volatility without the need to predict the exact direction of the stock move. By leveraging the natural decay of short-term options while maintaining exposure to earnings-driven uncertainty, traders can generate consistent low-risk returns.